Okay, so question 4 on 1st July will be on specialized transactions, where they either examine you on reorganization or liquidation issues, or they will examine you on business valuations. Okay, business valuation has been, for the past 3 sittings, it has always been business valuation. It can still be a business valuation, so you don't have to uh, you don't have to be gambling with your life. Anything can happen. So learn the business valuation, then you still learn the capital reorganization. They are all important. That is why they are all in the syllabus. So we try to see if we can solve 2 questions on capital reorganization and another 1 question on business valuation. See, we are just preparing, so anything is possible. So under the specialized transaction, it will always be for 15 marks. So this one, the examiner has the choice to pick questions or set questions on business valuations or capital reorganization. Okay, so the capital reorganization, if your double entry principle is very good, you don't have problem. And if you also understand the issue of income and expenditure, how the effects that they are going to be having on the debit and the credit side to you don't have any problem with that one also. So let's pick question. All right, so let's pick question number 1 without wasting time. Auntie Agnes, are you there?
Yes, sir.
Okay.
Question 1.
Oh,
Abwa Limited was incorporated some years ago to carry on business as manufacturers of fruit juice. COVID-19 and poor management has plagued the company into losses, which is potentially eroding the capital of the company. The statement of financial position of the company as at 31st December 2021 is given below.
okay. Let's come to the requirement first. Whenever you see a question, read the requirement before you start reading the question. So what is the requirement?
A. Calculate the amount that would be received by each of the providers of finance if the company was to liquidate. B. Prepare the statement of financial position after the implementation of a capital restructuring scheme.
Okay. So they are saying that the company, the first option is that they should go on a voluntary liquidation, isn't it? All right. So if the company is liquidating, what will happen? If the company is liquidating, what is the first thing that the owners or the management will be doing? What will be the first thing?
Assets will be sold.
Okay.
They will prepare a statement of liquidation where assets will be disposed of.
Okay. So when the assets are being disposed, the proceeds will be used to what? To settle.
To settle the liability. To
settle. All right. So
creditors in.
The first thing is you should go and do. Please, any question that we are solving here, you should take it. I don't know. You will not have the question before going to the exam, but anything is possible. All right. So we have, you can also write liquidation option or statement of distribution. Okay. So statement of distribution. So statement of distribution. So you have, what will happen is that you have to sell your assets. So the question will always give you the proceeds from disposal or proceeds from assets. Please, you don't have time to be writing plenty things. So proceeds from assets. Okay. So let's take those ones one by one. Okay. So the question, they will give you the, don't bring the carrying values. No. If we are disposing, it might happen that we even sell the asset more than what they are carrying values over here. So ignore this one unless you are not giving the fair value of the asset before you assume that, okay, so the carrying value is the same as that particular one. So ignore these ones now. Let's come and look for, okay, the first one. What are they saying? Plant and equipment is what? How much? So plant and equipment is how much? The first footnote. How much are we selling it?
15,000.
Okay. So the following assets values were relevant in liquidation. Okay. So we have 15,000. We are selling that for 15,000. Okay, we have the 15,000. Okay, the next one is what?
Inventory.
Okay. Some of them they will not give you. So let's have the inventories. Inventories is how much?
88,000.
88,000. Okay. What is the next one?
Trade and other receivables.
So we have trade and other receivables.
160,000.
160,000.
And
Okay.
trademark 6,000.
Trademark. Please, unless you are giving the value for intangible assets in the times of liquidation, unless you are giving the value of the intangible assets, we assume that they are going to be surplus. Okay, unless they are saying that this will be sold for a particular amount, we ignore the intangible what assets. So if you are not giving any value, just ignore. All right. So trademark is what?
60,000.
50,000. Okay. So we have to be reading because we have more than those assets. So we have to be reading and see whether what will happen.
Trademark is 60,000.
60.
Yes, please.
Okay, 60. Sorry. So we have 60,000. Okay. So let's continue reading and see whether we need to have the value of investment property. Goodwill. Who is going to buy the goodwill? So goodwill will be left there. Okay. So goodwill will not be part of the process. We are not going to be. You can't be making a loss and be. So the goodwill, nobody's going to buy the goodwill. Okay. You have a bad name already. So we have the property, plant, and equipment. We have the trademark. We have the investment property. We also have inventories. We have the receivables. Do you have the inventories already?
Yes.
Okay, so we bring the cash and cash equivalents. That will still be the same amount that we're having. So we have the cash and cash equivalents. So cash and cash equivalents. That will still be the what? The value of the cash and cash equivalents. So how much is it? It's how much, please?
65.
It's 65,000.
Okay. So let's see the next one that we need to have. So it means that we need investment property.
Hello, senior.
Yeah.
So always is the cash included when you are looking for the proceeds for the disposal?
12,000.
We are not actually looking for, we are just looking for the value that we are going to be realizing from the asset. Are you okay? So the cash will still be, you are not selling the cash, but you still have the cash. Okay. So maybe it might be the heading that is worrying you. So you can ignore that heading and just say, okay, asset. Maybe you can say asset over there. There's no problem. But the cash will still be the money cash will be part of the money that you'll be using to settle the people. All right. So the cash will be part of the assets. But we are not selling the cash. It's just the money that we have. Okay. So you can ignore the proceeds and move on. Are you okay?
Thank you.
All right. So the investment property, we need to read to the end of the statement to see whether we are still selling at the 12,000. No difference is coming. Okay. So let's come to the question and see. Okay. Face charge, ordinary shareholders, the preference shareholders, 20%.
0.9.
Okay. The debenture is secured by a floating charge over the assets other than the investment. The current market value of the investment is the current market value of the investment is 15 million. Let's see. Okay, that should not be. So that should be investment. They should not add property to it. Okay. So the debenture is secured by floating charge over the asset of Cabo other than the investment. Okay, the current market value of the investment is 15. The debenture is secured by a floating charge over the asset of Cabo other than the investment. The current market value of the investment is 15 million. So that should be 15 million, but that should not be termed as investment property. So okay. So that will be 15 million. Okay. So that will be 15,000, not 15 million. Okay. So we have the investment over there to be 15,000. Okay. So let me just write the investment property. So 15,000. Okay. What would be the, I'm sure we have all the value of the asset. What would be the total process?
$403.
103,000.
Aye.
Okay.
Confirm.
So what do we do? We now distribute, isn't it? Okay. So the distribution, the first one will be, the first distribution will be given on what?
The secured
Fixed
Secured
charge.
charges.
with fixed charge.
Okay. So,
Secure with fixed charge.
okay. So a loan that is secured on a particular asset. Let's come here. The point 2. Cabos Limited Bank holds a fixed charge on the property, plant, and equipment as a security for the overdraft. So the first distribution will be given to the overdraft. What is the overdraft? What is the amount for the overdraft?
9,000.
Okay.
9,000.
How much are we selling the property?
15.
15,000.
It means that we can settle all the overdraft, isn't it?
Yes, ma'am.
Okay. So if you cannot be able to settle, you only use the portion that you can use to settle that. So we have the 9,000 as a distribution here. Okay. So the fixed charge is that the assets, if we are not able to pay, you are coming to take the assets. So we are using the asset as a collateral security. So whatever happens to that asset will happen to the money that we are taking from you. So if we sold the asset, the money will be used to settle you. So if we sold the asset for 8,000, we only give you the 8,000, the remaining 1,000, that 1,000 will now become unsecured creditors, and you now wait for any
Yes, sir.
proceeds that will be coming, any reserves that will be coming after settling the other people in order. Then you also take the remaining amount out of that. Okay. Let's see what we are going to be having here also. Question number the 3 is about restructuring. The 4. Okay, the preferred dividends. Okay, okay. So
Pension payables.
then after the secured loan or secured overdraft or anything, the next thing should be liquidation expenses before you move on to the preferential debt. Okay. So we have the
Preferential securities.
okay. So you have the liquidation expenses. So we have the liquidation expenses. How much is the liquidation expenses?
50,000.
I'm having 5,000.
No, 5,000.
Okay.
15 million of trade payable preferential 15 million.
Yeah, you settle
Yes, 5,000.
you settle liquidation expenses before the preferential one. Okay, so the secured loan secure on a fixed asset will be the first one. The next one is the liquidation expenses. The third one will be the preferential was debt and those ones. So this is where we have
Payables.
preferential. Okay, so we say 50 million and 140 million. 50 million of the 140 million trade payables are preferential. Okay, so the trade payable is 140 here. They are saying that 50 million out of that is preferential. So that might be maybe tax owings. We are owing GRA and those people. So they want their money. Okay. So we have trade payables. So we have trade payables to be 50,000. Is that correct? All right. Please, you should be
Yes,
subtracting the figures. Okay. So let's now move on. After the preferential, what will happen? We now look at floating charges, isn't it? Now let's wait to see whether we are having.
Venture.
Floating
Nine.
charges is
Okay.
9.9.
Okay, the debenture is secured by a floating charge over the asset of Cabo, other than the investment. The current market value of the investment is 15 million. So let's count to debenture. How much is the debenture?
150,000.
Okay.
150,000.
Yeah, the question is the proceeds that we have after we have settled our bank overdrafts and the 50 or the 5,000. Can we be able to settle the remaining? So 403 minus 14,000. Okay, so we can settle all
Yes,
the.
we can.
Okay. Okay, so we can settle all. So if you settle the 150, you will still be having 189. Okay, so we can have the debentures here as the floating charge. So that will be 150,000. Okay. So do we have any other preferential? Do we have any other thing that we have to settle in terms of preferential? Okay. So the payables will be left with how much?
Mm, it will be left with 90.
90.
Okay, it will be left with 90. Okay. And a long-term
90,
loan
yes.
also. The long-term loan also, if you add it to what are we getting?
We're getting 160.
So can our remaining proceeds be able to settle all?
Yes,
Yes.
we have a remaining proceed, 189.
Okay, so you can settle all of them, isn't it? Okay.
Yeah.
So we can, the only time that we do the apportionment, sometimes the portion, if you do it, the remaining process will not be up to the unsecured creditors. Okay. So you have to share the remaining amount based on their carrying value there. But this one, we can be able to settle all. So we have the trade payables to be 90,000. Then we have the bank loan of 70,000. What will be the remaining process?
So can we make the trade payables other trade payables so that it will distinguish from the previous one?
Okay. Thank you. So let's have the other payables here. Okay. So the other payables. So what will be the remaining process now?
29,000.
20.
29,000.
And this will be given to which people?
29. Ordinary shareholders.
Are you sure? We don't have preference shares.
Relative preference shareholders.
Okay. Let's the capital of the company is made up of 60 million shares at 0.85 per share and 9 million 9 million, 15% what? Cumulative preference shares of no par value. Okay. So we are having 9,000. So it means that we can actually pay the preference shareholders, isn't it? Okay, but let's come here. The preference share dividends and debentures interest are 3 years in arrears, but have wrongly been credited to the trade receivables. So we have interest on those ones also. We have to pay the dividends before the interest and dividend before these people, the ordinary shareholders will take something. So the preference share dividends and debenture interest are 3 years in arrears, but have wrongly credited to trade receivables. Okay, the preference and dividend holders are willing to convert all their dividend interest in arrears to ordinary share of 1.25 each if the capital reconstruction scheme is accepted. So it means that the receivables figures that we have over here is including what is a net of the interest for the debentures and also the preference shares dividend. So can we calculate the interest that is in arrears and also the preference dividends?
Yeah. Hello, sir.
Yes, please.
Please, I do have a question pertaining to the long-term the debenture.
Is that?
I do have a question pertaining to the long-term loan, the debenture.
Okay.
So pertaining to that one, so in case it was secured by a fixed charge and you are paying, are you supposed to pay the principal plus the interest, or you pay only the principal and later you pay the interest?
It is a principal that is secured against the asset, not the interest. So you only pay the principal.
Okay.
All right. Okay. So the interest will become unsecured because you are having issues, you're having problems. So they are only concerned about what? The principal. They can decide to forget about the interest, but the principal payment is very important than the interest. Okay. So let's come to what is the interest on the debenture?
4,050.
The debenture, I'm getting 18,000 multiplied by. So it means that we don't have to do these ones. Okay, this one's supposed not to come now. Okay, let's put all the unsecured creditors together. Okay, so we are going to be having interest. Interest on debenture will be, I'm sure that will be 0.12 multiplied by 150,000 multiplied by 3. Is that correct? The debenture will be 12% on the principal, which is 150,000. And they say these are 3 years in arrears. Okay. Are 3 years in arrears. So what is the interest on the debenture?
54,000.
That will be 54,000.
54,000.
Okay.
Mm.
So let's have 54,000. So our preference dividend will also be preference dividends. Let's also calculate the preference dividend. Okay. The preference dividend will be, okay, so we have issues about preference share over here. They say it is 9 million, 15%, and the principal is 9 million. So that will be 0.15 multiplied by 9,000 multiplied by 3.
13,
40, 50.
13.
40, 50.
Okay.
No, 40, 50.
Sorry, 13, 40, 50.
No, it's 40, 50, not 13.
40, 50.
Okay, thank you. So we have 4050. So let's now put all the unsecured creditors together. These are all going to be part of the what? They are also owings. So they are part of the people that we are owing. So we'll be having the So we'll be having the other payables of 90,000. Then we have the bank loan.
Professor,
Yes, now.
is the interest on the preference dividend? Should the computation be on the face value of the dividend or the value stated in the statements of financial position?
I'm not sure they have value in the statement of financial position.
Perfect.
That's the 9,000.
They just give you share capital. So they are giving you the component of the share capital. So the share capital consists of preference shares and then the ordinary shares. So they are giving us information on the components. So the stated capital of the company is made up of 60 million shares at 0.85 per share. So just do 0.85 multiplied by 60. I'm sure you'll be having 51. So if you add a preference shares of 9 to it, you'll be getting the 60,000 they have there. All right.
51.
Okay, plus the 9. Then we have the
60.
then we have the 60. So they don't have any figure for we don't have figure for preference shares here, but he has given us the preference shares. Okay. So that will be 4050. Then we have the bank loan of 70,000. Then we now have the interest owings of 54,000. Then we have the preference dividends. That will also be owings of 4050. What are we having?
Two 188,050.
218,050. So this is a total unsecured what? Unsecured creditor. So we cannot pay those people. We have to share the money between them. Okay. So after sharing the money, after everything, what will be the balance? I'm sure that will be 289, isn't it? Or it was 189.
189.
Okay. So this 189, this is how the 189 will be shared. So we come to other payables. Okay. So the other payables will be having 90,000 divided by 21805 multiplied by 189,000. Okay. Then we have
Yeah, please, the total figure for other payables, somebody should confirm because I'm having 169,450.
169.
450.
Other
The
payables is
It's
90,000.
confirmed 218,050.
90,000, 70,000.
54,000.
Okay, the interest is 54,000.
Yes,
And
please.
405. It's correct.
So we can move on.
Say,
Okay. So if we multiply that, what are we having?
We're getting 78,010.
Okay. So 78,010. Let's come to 70,000 divided by 218,050 multiplied by 189,000.
6074.
60.
74.
Okay,
No, 60674.
Okay, 674.
Okay, 6067. Yes.
Okay. What would be the interest? What would be the interest here? 54,000 divided by 218050 multiplied by 189,000.
What is 6806?
What is 6?
806.
Okay,
6.
806. Okay. Then let's come to the preference dividends. Please, they are all going to be classified as unsecured creditors. Okay, these are all the people that we are owing. Okay, so we have 40, 50, and we have the 218050 multiplied by 189,000. What are we having?
3510.
Okay, 3510.
510.
So if you put all together, you'll be having the 403,000. Okay. Okay. So please, it is they can actually examine you on capital reorganization because the business valuation cannot be 4 times. Okay. So the capital reorganization, it will come with maybe it will either come with the liquidation or it will come as a question on its own. You should always look for that. How you are going to be distributing the process is very important. The distribution of the process is very, very important. Okay, so we always have to pay attention to the items. The fixed charge will always come, liquidation cost, preferential debt, floating charge. Then you now distribute the remaining among the unsecured creditors. Okay, this is how the distribution will be done, and that is what they are asking us to do. You see, they can ask you to advise whether the entity should liquidate or they should reorganize. From this position, what are you going to be telling them?
Daniel, please check your microphone.
Okay.
Okay. So from this position, what we have done right now, what are you going to tell them? Should they liquidate or they should turn around?
In liquidating, sir, it means that the shareholders will be at disadvantaged.
Yeah.
So it will be better for them to turn around because since the shareholders wouldn't agree to lose their investment like that,
they are the one who are going to approve the decision. So you cannot
yes,
say that I'm going to be losing my money and you are asking me to what? You can see that only the preference shareholders are getting something. That one cry is they are not getting their principal. They are getting portion of their dividend. So their 9 million will be going, and the preference share, the ordinary shares, their 51,000 will be going. The 51 million will be going. No, they cannot approve this. So it's better if the company is having a prospect. It's better that we should turn around and go back to our profit making this. So the question will be asking you to prepare a statement of financial position after the capital reorganization. So what do? Just go and put the statement there. Put your statement of financial position there. Okay, bring the items, put them in brackets. If there's any addition, add. If there's any subtraction, subtract. Then that will give you more ticks. The target is to get more ticks. Okay, so let's come to the name of the company. Okay, statement of financial. Statement of financial. Yes, yeah.
Please, with the distribution of the unsecured creditors, can you do the calculation as a working and transfer it to the distribution list?
Within the 3 hours.
Yes, within 3 hours.
Okay. If you can do it, no problem.
Okay.
All right. If we can do it, no problem. But yeah, that would be okay. Some people they are actually fast. So statement of financial assets. Yes, yeah.
Yeah, is a preferential creditor the same as a preference shareholder?
There
Or
was
is different? The preferential creditor?
preferential.
Is it the
No.
same as
Okay.
the preference shareholder?
The preferential creditors. Are you saying preferential creditors? Yeah.
Yes.
Okay. Someone said no, so the person is ready to answer.
Okay.
All right. Someone said no. I've heard no.
Yes. Preferential creditors, they are the tax people and the SNITs, that legal issue people.
Salaries in a
Okay. So yeah, Sina Clement. You see, in a time of reorganization, there are some certain number of people that we are going to be ranking them. Like some people that no matter what, we have to pay them first before any other people. So it's just like you also have preference. Okay. Maybe you have five keys. It's not all the five that you are going. So you also have preference. So if you have money, there are certain people that you are going to be sorting out first before the remaining ones. So those people you are going to be sorting out, those are people that we are calling the preferential people to you. So they are not preferential holders. They are debts that we have to settle at all costs. So most at times is the redundancy cost, the needs, the money that we are going to be paying to the tax authority. All those people are the preferential. So the question will always tell you the preferential people. All right.
Okay.
Okay. So
Sir,
yeah.
can one consider the salaries owings in salary owings for employees as also part of the preferential period?
Exactly. If you are closing down and you are not giving money to the people, how will the people survive? So if you are giving salary owings in the question, the salary owings, no information is given, please treat it as a preferential amount, unless they are you have to pay the workers. You have to pay them. They are going. You have to give them their money before they will go, because these people are working for you. So you have to treat them. You have to treat them as one of the important creditors that you are going to be. They cannot be treated as unsecured. No, how? Someone who has family. Okay. So yes, that should be the it should also be treated as preferential creditors.
Hello, sir.
Yes, please.
Please, I would like to ask if you can use this the liquidation aspect that we have completed. If assuming we've been asked to do calculate for how much each will be losing, like the maximum loss. Can you please use this solution to elaborate on it shortly for us, if it's possible?
The maximum loss will always come in if you want to do the reorganization. Okay, so that's how you have the issue of the maximum loss. So maximum loss is calculated if you are doing the capital reorganization, because from this place you see that these people will be the other payables, they are having 90,000, but they will be losing 7,810 if the loss is relating to these people. But the maximum loss is always relating to the what? To the preference shareholders, the preference shareholders and the ordinary shareholders. But if they are asking you how much would the creditors not be receiving, what amount of their portion will not be received, then this case you're supposed to pay the other payables 90,000. You are giving them 78,100, 78,010. So it means that out of the 90, how much are you paying? 78,010. So the remaining portion will be the amount that they will be losing if the maximum loss should be calculated in their regards. But mostly the maximum loss is for the portion that the preference shares and the ordinary shareholders will be taking if we want to reorganize. So if it is for the debt, the creditors, then you just look at the amount that you're supposed to pay them, the distribution that you have done with them, then you subtract. That is the difference. So 90,000 minus 78,100 70,010, 70,000 against 60,674, 54,000 against 46,806. Then you also have the preference dividend 35,110 if you are doing the liquidation and they are asking you to calculate the maximum loss from the liquidation. Then other payables will not be taking a portion of the amount, which is 90 minus 78,010. Bank loan will not be taking portion of the amount, that will be 70,000 against the 6674. The debenture holders, their interest, they will be taking only 46 out of the 06. So they will be losing a certain amount over there. Preference shareholders are not going to be taking any amount. They are only going to be taking 35,10 of their what? Of their dividends. So they are 9 million, they will not take it, plus the portion of the dividend that they are not taking. Then you count to ordinary shareholders, they are not taking anything. So if they are asking you to calculate the loss from the liquidation, that is how you go about it. But if they are telling you to calculate the maximum loss, the maximum loss is always if we are doing the reorganization. If we are doing the reorganization. Auntie Emilia, I hope I have at least answered
Yeah,
your.
I'm okay with it.
Okay, all right. So any other issue before we move on to the statement of financial position?
Hello, sir.
Yeah.
Please, why was the preference dividend added to the unsecured creditors?
The preference dividend will be owings, isn't it?
Yes, sir.
Okay. And preference shareholders are not owners of the company. They are actually creditors. Okay.
Okay.
The owners of the company are only the ordinary shareholders. Okay. So if you are owing those people, you are going to be paying them. You are going to be paying them. So they are actually preference shareholders are actually creditors, not owners. Okay, they are not part of the owners. They are not having ownership in the entity. So that amount will be owings, and that will be treated as part of the unsecured creditor. But if it should be ordinary dividend, then what will happen?
Yeah. Yeah, I saw a solution in the book where they pay the priority creditors before the liquidation costs. So like with that, they pay the priority creditors, that's in the snakes and those payments, yeah, before the liquidation costs.
That it's me that one that particular thing has been done because maybe no matter how you arrange it, you still have an amount to pay the liquidation cost.
Okay.
So but if there is, so maybe that one the ranking was actually done anyhow because they still have a lot of amount to pay. After paying the preferential people, you still pay your liquidation cost out of it. But the liquidation cost should be paid immediately. If you're not paying the liquidation cost, how would the people carry out the liquidation process? If you don't have the full amount to pay the liquidation cost, it means that the liquidation itself will not be successful. We are not going to help you to do it. So after the fixed charge, the next one should be the liquidation cost. If you actually want to carry out the liquidation as planned. Okay. So let's come to the statement of financial position. This will be prepared immediately after the what? The reorganization. So you can just put maybe the financial statement, the date of preparing this financial statement, the first one that we have. Okay. You can just what is the date? 31 December, isn't it? Okay. So you can name it 1st January. You can say the immediately the next day. Okay. Nobody's going to lash you. Okay. So you can also say statement of financial position immediately after the reconstruction without any date. Okay. That is no problem with that. Okay. But you can also use maybe as at 1st January 2022. There's no problem with that. Okay. So we have the January 1, 2022. Okay. So what we have over here is that we have placed for the purpose of ticks. Okay. This is how we are going to be presenting this. Okay. The target is to get more marks through the small ticks that they will be giving to you. Okay. So let's come to our assets here. Okay. We will be having non-current assets. we'll be having non-current assets. So the non-current asset will be, the first one is PP, isn't it? What is the value for the PP? What is the carrying value? No, carrying value. The value that we have in the books.
22,000.
Okay.
22,000.
You just bring the book value before. If there's any addition or subtraction, you come and subtract. They will mark this one and mark the subtraction also. Okay. So the next one is trademark. Okay. The trademark is 40.
Hello, sir.
Yes, please.
Yeah, please, I want some clarification. So pertaining to the way you are doing it, can you decide to do the capital reduction separately and later on you do the balance sheet?
The purpose is about the work itself should come first before the workings. So I'm going to do the workings after this one before I'll go and do the workings for the capital reduction. I'll go and prepare the capital reduction accounts. Okay. So if you want to do the working before that one, so there's no problem with that. Okay. But the requirement is to prepare statement of financial position. So I will do that one first. Maybe that particular day, the examiner might not be in his right senses, and he will just say, okay, I haven't done this and anything can happen. So I have to prepare my own first before I go to the workings. So I will just be lifting the workings there to this one. But anyhow you do it, there's no problem. As soon as you are going to prepare the financial position, there's no problem with that. All right.
Okay, thank you.
Okay. So we have trademark to be 45,000.
5,000.
Okay. Then we have the investments. I don't know why. Actually, I didn't read the question. So that will be 12,000 that we have, isn't it? Okay. So we have the goodwill. Please, goodwill will be written off, but bring it and subtract the figure again. Are you okay? Okay. In times of reorganization, you cannot be making losses and still be saying that you have a good job. So the good job will be written off, but what we do is that bring the figure and come and subtract the figure again. Okay, so good job will be 48,000. So at the time that we are doing reorganization, all intangible assets should be written off unless they are having a market value. Especially goodwill should be written off, but the trademark and patents, maybe they can say that this can be sold at a certain amount. So their value will now be the resale value. Okay, so let's come to current assets. So we have the current assets. Okay, the current asset is what? The first one is
Inventory.
okay. How much is it?
108,000.
Okay, 108,000. The next one is what? Receivables.
194,000.
Okay. 100 and what?
94,000.
Okay. Okay. Then we have cash and what?
Cash equivalent 65,000.
Cash, don't write it. There might be some cash coming in. So maybe the cash figure will be plenty. So you have to go and maybe prepare a cash book to get a figure. But if it will not be plenty, you can just add in a bracket. Okay. So since we are here to read the footnotes, let's have our cash and cash equivalent at a figure that we have to come and determine later. Okay. So let's come to equity and liabilities. So we have the stated capital. The stated capital, we can now separate it now. Okay. So we'll be having ordinary shares of 51,000. Do you agree to that? And preference shares of 9,000. Is that correct? I hope you are okay with that.
Yes.
Okay. So let's come to non-current liabilities. Another non-current liabilities, we are having 12% what?
Bank.
Okay. And the amount is 70,000.
150.
Okay, 150,000. And we have the bank loan, which is 15%. Okay, that will be 70,000. Okay, do you have any other? So you can leave a space like 2 there, then you count to current liabilities. Okay, so we have trade payables. How much is the trade payables?
140.
140. Okay, then we have the bank overdraft. Overdraft is how much?
9,000.
Okay, 9,000. So sometimes some people will be doing what we call maximum loss, please. If you count, the maximum loss is just a capital reduction account in a vertical format. Please, if you know that the maximum loss, you find it difficult to use the or you find it difficult to use the vertical format to prepare the capital reduction account, please, you can write your maximum loss at the top here. Okay, you can write your maximum loss over here, and you do it in a vertical format. You can decide not to name it capital reduction account again. Okay, the maximum loss. Some of you have seen maximum loss in some books. It is just a capital reduction account that they are preparing in a vertical format. So go with the one that you like. If you prepare a capital reduction account, you will still be getting the same loss that you'll be sharing to the preference shareholders and then the equity shareholders, like the person that will be doing the vertical format as the maximum loss. So you just go with the one that you are comfortable with. But let's see if I can show the two so that you select the one that you like. Okay. So let's have our capital reduction account over here as part of the workings. Okay. So let's have our capital reduction accounts here.
Senior.
Yes, please.
Yeah, I realized you didn't add the capital surplus to the so we will create a different account for it.
Well, we have only one capital surplus, isn't it?
Yeah, the 70,000.
Okay, we have 70,000 and retain earnings. Oh, sorry, we're supposed to, although we are going to be eliminating it, but it's supposed to come. So we have the capital surplus. Okay, the capital surplus will be written, the retained earnings will be written against the capital surplus. So how much is that?
65.
All right. So the capital surplus will be the retained earnings. So this will be 65,000. The retained earnings is what? Is negative, isn't it?
Negative 5,000.
Yeah, negative 5,000. Please don't say that why they are having capital surplus of 65,000 and they are having retained earnings of negative 5,000 and they want to close down. Please, capital surplus is just a revaluation. It's just something, it's not cash. It's just something as an increase in the values that you're having. So it can be revaluation surplus or maybe fair value gain on your financial instrument that are carried through other comprehensive income. The return is the actual profits that you are making. Okay, so you are making losses there. So let me just bring the non-current liability at the down here. Yes,
The capital surplus is 70,000.
70,000.
it's 70,000, sorry. So 70,000. Okay, so let me bring the current liabilities here, non-current liabilities here. So I can have 12% debenture. That will be 150,000. Then I have the 15% bank loan to be 70,000. Okay, so let's have our capital reduction account over here. Okay. The last, you have to look at the last statement there. Okay, there is a last statement there, which is talking about. Please, what is the first thing that you have to write off?
Retained earnings.
Okay, so if you are writing the
Retained
return,
earnings.
the return earnings off, are we going to be debiting or crediting?
You debit it.
Okay, so
Debited.
the capital reduction account will be debited. Okay, so the retained earnings over there, I said that it can be treated as an asset because it's a negative figure. So you can decide to go and add it to the asset. So if you are writing your asset off, it means that you are losing. So this will be considered as an expense. The next one will be the goodwill, isn't it? So if we are writing our goodwill off, so we come here and add 5,000 to cancel this. Okay. So how much is the goodwill? 48,000. The goodwill is an asset. And if you are writing an asset off, that is a cost to the entity. You bought something, 50,000, and you are not trading it. It means that you are losing. That will be a cost to you. So this is just like income and expenditure. Expenditure on the debit side, income on the credit side. So anything that is going to be coming as a gain should be credited. Anything that is coming as a cost to the entity should be what? Should be credit, should be debited rather. Thank you. All right. Let's come to, there's a statement over here that you have to deal with. Okay, you don't have to go and suffer. The liquidation values for the asset as well as expenses to be incurred are considered relevant in the event of any capital reconstruction scheme. Okay, what they are telling you is that the liquidation values are the same as the revalued amount if we want to if we want to reconstruct. Okay. So they are saying that our plant, the revalued amount of the plant and equipment, property, plant and equipment is how much? What is our fair value?
15,000.
15,000. But the actual value, actual book value is how much?
22,000.
Increase or decrease?
Decrease.
And that will be a loss, isn't it?
7,000.
Okay, so there will be a loss of, so you bring your property, plant and equipment here. If you like, you can put 22,000 minus 15,000. You can show how you get your figures. Okay, what are we going to be doing? We have to reduce.
Subtract it from the PP.
Okay, the actual value should be 15,000 now. So we go and remove this one. So if care is not taken, you can even get more than the 15 marks because the ticks will be plenty for you. Okay. All right. So let's come to the next one. Inventories. Inventories will be how much? Our inventories is
The
8,000.
book value will be 108.
Okay, and the fair value is what?
88.
Okay,
88,000.
what is happening there?
There's a loss
20,000
of
decrease.
2,000.
Okay, so we have the inventory of 20,000. Okay.
Yeah.
So we go and reduce our inventory also by 20,000 to now have 88,000 now. Okay. Let's come to another issue here. Okay. The next one is what? Trade and other what?
Trade and other receivables.
160,000, isn't it?
Yes, please.
Okay, please come here. Don't go and treat the trade and other receivables. The receivable is 194 over here. Okay, don't go and treat that as the value. There is a statement about the trade and other receivables here. Okay. 5. The statement, the fifth one, the footnote 5. The preference share dividends and debenture interest are 3 years in arrears, but have been wrongly credited to the trade receivables. Okay, the preference shares and debenture holders are willing to convert all their dividends or interest into in arrears to ordinary share of 1.25 each if the capital reconstruction is accepted. So what's supposed to be the actual receivables? They have net the interest and the dividends in arrears against the receivables. Okay. So it means that our actual receivables should have been 194,000 plus the interest of 54,000 plus 4050. Is that correct?
Please, where from the 40?
Okay. All right.
Can you come again, please?
Oh, don't worry. I'll come. What are the figures that we calculated here? The interest calculated for 3 years is what? 54,000, isn't it? The preference dividend is what? 4050. So those are the figures that has been wrongly credited to what? To the receivables.
Yeah.
So are we
Okay.
now going to subtract it?
No, they have subtracted it. So we want to know the actual receivables. So we go and add and now bring these ones as owings now. This should be shown as owings. Can we move on?
Yes.
Okay. So I hope the explanation is okay. Okay.
Hello, sir.
Yes, please.
So it means that they've already deducted it from the receivable.
Yes, please. That's what they are saying. Yeah. So we go and add back and bring those figures as payables now. They will be classified as payables. Okay. So the preference share dividends and debenture interest are 3 years in arrears, but have been wrongly credited to the trade receivables. The preference and the debenture holders are willing to convert all their dividends or interest in arrears to ordinary share of 1.25 each if the capital reorganization is going to be successful. So this is what we are going to be doing. We have to rectify that particular mistake. So let's bring the interest and dividends over here so that we can actually, so we're going to remove it from that place, interest and dividends. Okay, so we bring it now as, so interest and dividends, that will be 54,000 plus 4050. I hope you're okay with that. Okay, then the receivables, can we add that figure to it? Can we add the 54,000 and that one so that the effect will be, so I'm having 58. Okay, so this one I can just stand up and do all the entry for this, but for the purpose of learning, so we're going to have our actual receivables now. What will be the actual receivables?
Hello, senior.
Yeah.
I thought, or I was thinking that you would rather adjust for the fair value first before we do the addition.
No, no, the receivables, the actual receivables is not 194, but you have subtracted the interest and those ones from the receivables. You have netted it against the receivables. So receivables should have been 194 plus the amount that you have subtracted. Okay. That's the receivables there. Then we will now go and send these figures over here, although they have said that it will be converted. But if we get to that footnote, then we now do the conversion. Okay, it will be these figures will now be transferred to ordinary shares. Okay, we come and convert it by sending their figures to ordinary shares. But if we get to that side, then we now come and do the entries for this. But I just want to eliminate so instead of them showing the interest and dividend as payables, they have written that particular value against the receivables. Okay, so our actual receivables are supposed to be 252050. 252050. Is that correct?
Yes, please, it's correct.
Yes.
But what is the fair value of the receivables given to us?
160.
Okay, so there will be a reduction of
92
Okay.
05.
Okay. This one you can even name it bad debt, but just write your receivables and you move on from there. So let's come to the trademark. Trademark. Okay. Trademark is how much? Our book value is 45,000. Okay. But what is the value over here?
60.
So what is happening there?
It has increased.
So that increase will be
Credit.
okay. That will be a gain by 15,000, isn't it?
Yes, please.
Okay. So we go and now increase the trademark to 60,000. All right. So we are done with, we have written off the goodwill already. So let's now take this is not relevant for us. The 2 is not relevant because that is relating to what? Liquidation. We don't have problem with that. Let's come to 3. Auntie Agnes, are you there?
Yes.
I'm doing your work for you. How come? All right.
Okay. 3.
Yeah.
The stated capital of the company is made up of 60 million shares at 8 CD 50 pesos. No, at 85 pesos
Okay.
per share and 9 million Ghana cedis, 15% cumulative preference shares of no par value. The shareholders are willing to write off 75% of the share capital in the case of any capital reconstruction.
Okay. They say the shareholders. Who are the people that they are referring to?
The ordinary
Ordinary.
The ordinary.
shareholder.
Okay, not the 2, not all the 2. Then not the preference and then the what? Not the preference and the ordinary.
No.
Okay. 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 I will take that. Okay. Okay. I will take that with the assumption that the shareholders are the owners of the company. Okay. The shareholders are willing to write off 70% of the share capital in case of any capital reconstruction. Okay. So what is the amount that they are having currently? What is the value that they are having? They are having 51,000.
1,000.
Okay. So if they are writing 75 off, they will be having 25 remaining, isn't it?
Yes, please.
Okay. If the equity shareholders are writing down their share, would that be an income or expense to the entity?
An expense.
Are you sure?
It's
The
a gain.
Writing it.
The entity is a separate legal entity. It's different from the owners.
Okay.
The company is supposed to be paying the people 51,000, but they have not accepted 25. It means that the company will not pay all the full amount. So the company will be saving the 75% over there. Okay. That will be a gain. Or you can also pass the double entry to determine that. At any point in time, you can pass the double entry. So we have the share capital account. So you'll be having a share capital account. Okay. So this share capital accounts, this will be a balance brought down, isn't it?
Yes.
To 1,000. So we are now writing 75% of what will be the value that we are writing off.
38,250.
Okay. So it means that the 38,250 have to be here so that we can. Okay. So you can just do capital reduction over here. You are writing this to capital reduction. So you are debiting the share capital, meaning that you are going to be crediting the what? The capital reduction. That is actually a gain. So, but please, this double entry, which will take your time. So just look at it. Will this be a gain or this will be a loss? Just analyze it and you look at it. So we have the share capital. We have the share capital of 38,250, isn't it? Okay. So we come here and subtract 38,250. Am I correct?
Yes, please.
Okay. Okay. So let's move on now. Let's move on now. Okay. The ordinary shareholders have decided to inject 75 million in consideration for a new issue of equity shares issued for.
Hello, sir.
Yes, senior.
Sorry for taking you back. Sir, pertaining to the capital, the reduction in capital.
Yeah.
The total capital was 50,000.
The stated capital is comprised of equity shares and preference shares. So they have given us a breakdown. Equity is 60 million multiplied by 0.85. So if you multiply, you'll be getting 51 million. Then preference shares portion is 9 million. So that is why we have a 60 there. Okay. So the equity people are writing their shares down by 75%. I hope you're
Okay, sure. Thank you. Yeah.
Okay. So let's come to the ordinary shareholders. Okay, on to Agnes.
Four, the ordinary shareholders have decided to inject 75 million Ghana cedis in consideration for a new issue of equity shares issued for 50 million shares at 1 CD 25 pesos, and the remaining amount to pay off parts of the 15% long-term loans if the capital reconstruction scheme is accepted.
Okay, let's look at what they are saying here. Okay, they say they are willing to what in just 75 million in consideration for a new issue of shares issued for 50 million shares at what 1.25. Okay, and the remaining amount to pay off part of the 15% long-term loans if the capital reconstruction scheme is accepted. So since we are preparing a statement of financial position, it means that a capital reconstruction scheme will be accepted because the liquidation option is not possible. So we have to now reconstruct. Okay, let's now find the number of the value that they are going to be having from the shares. What is the value that we are going to be having from if the shares are issued? That will be 50 multiplied by
500.
Those are 2,500.
that will be 62,500, isn't it?
Yes.
Okay. So that will be the value that will be going for equity. But what is the excess amount?
12,500.
Okay, that 12,500, how do the cash, we are going to be having a cash or bank of 75 million. Okay, then equity will be credited with what? 62,500. Where are we taking the remaining 12,500 to?
Long-term loan.
No, if you are crediting a long-term loan, okay, let me do the double entry so that you will not get it. So we are going to be debiting cash or bank, isn't it? 75,000. So we now credit equity shares, okay, of 62,500. So if we are crediting a long-term loan, it means that we are still increasing the loan.
So we are debiting. We are going to debit it.
If we debit, it means that the two sides will not be equal. It's supposed to be 75 debits, 75 credits. So you are going to be crediting share premium. The shares have been issued at a premium of 12,500. Okay. Then you are going to the shares have been issued at a premium. Okay. After this one, after recording this like this, then you now come and do your debit your loan of 12,500. Then you credit your cash. You have to use the cash to pay the 12,500. Are we okay?
Okay.
I hope it's clear.
Yes, please.
Okay. So that particular transaction is not going to be resulting in either gain or anything. So I can bring my share premium here. So it means that I still have to bring this one down. So I can bring my share premium here. To be 12,500. Then can I add the 62,500 over here?
Yes, please.
Okay. Then we come to, okay, we are going to be doing workings for the cash and cash equivalents. So maybe there will not be plenty issues on cash and cash equivalent. What is the cash figure that we have?
72.
Okay,
75.
75. Okay. No, the one that we have in the statement of financial position.
So 65.
Okay, that was 65. So we add a 75 to it now. So we have 65,000 plus 75,000. Okay, so we have the premium and this. Then what will happen? They say the remaining will be used to pay the long-term loan. So we now be using 12,500 to pay the long-term loan. So I'll count the non-current liabilities over here. So I'll have the 12% debenture to be 150,000. And I have the 15% long-term loan or bank loan. That will be 70,000 minus 12,500. Oh, that is okay now.
Yes, sir.
Okay. Okay, let's move on to Auntie Agnes.
Yes, sir. 5. The preference share dividends and debenture interest are 3 years in arrears, but have been wrongly credited to the trade receivables. The preference and debenture holders are willing to convert all their dividends, that's interest, all their dividends or interest in arrears to ordinary share of 1 cedi 25 pesos each if the capital reconstruction scheme is accepted.
Okay, we have accepted the reconstruction scheme because the liquidation is not okay for us. Okay, so what is the total interest here? The total dividend and interest. What is the figure that we have over there? 54 plus 40, 50. I'm having 58050. Is that correct? The interest and dividend together.
Yes.
Okay. They say this will now be converted towards equity share. So we are not going to be having this in our books again. It will now be moved to equity shares. So we now have 5850. They are converting the exact amount, so there is no gain or loss on this particular transaction. And we actually have this record in the books. There's a time that the records are not going to be in the books. You are going to be bringing it. That will be treated as a cost, or that will be treated as a cost. But we are having this in the books. We just do the transfer. There's no reduction and there's no increase. It's the same amount that we are converting to equity share. So there's no gain, there's no loss on this particular transaction. So let's come to the 6.
Hello, senior.
Yes, senior.
It's a question.
I
remember you gave us this question as part of our mock. Yeah, I was thinking that since they gave the share price previously the share price was 0.85.
They have changed the share price already.
Oh,
They have changed the share price to 1.25 now.
25 now.
Yeah.
Oh, okay.
Yeah.
I was thinking that you have to convert it back into the ordinary shares before you multiply it by them.
No, if you change it, you'll still be getting. If I'm owing you 58,000, I want to give you shares. No matter how the price, the share will be equal to the 58,000 that I'm owing you. But just that the number of shares will be reducing. So it's just the number of shares that will be affected. But the amount I'm owing you, I cannot give you more than the amount that I'm owing you. So the value will still be the same, but just that maybe the number of shares the number of shares will be, so if you want to find the number of shares, it will be 58050 divided by 1.25. You still come and multiply by the 1.25 to get
Okay.
it. So the value will always be the value. All right.
Right. Thank you.
All right, sir.
Yeah. Hello, sir.
Yes, sir.
Please concerning the question 4. No. The
The
second
note 4.
part, yeah, there's a question 4.
The note
The
4.
note 4, yeah, the second part, and the remaining amount to pay off part of the 15% long-term loan. So why the 12,500 being the share premium? Because it will be used to pay the loan.
Okay, we have issued the shares to them at 1.25, isn't it?
Yes, sir.
And they are paying how much?
75 million.
Whenever shares are being issued and the shareholders are paying more than they should, what is the name given to the excess?
Share premium.
Share premium. So we are going to be debiting your shares. The shares that we are going to be allocating to you will be only 62,500. So that particular one will not be a money to us that we are going to be keeping in the share premium. Okay, so we are going to be keeping that in the share premium now. Okay, that share premium is also in our bank account. So we'll be using that now to pay the loan back. Okay, if you don't take time, you want to do the entry, you have to be. So first, Aunt Emilia was thinking that, okay, the credit entry should go to loan. If you are paying the loan, so if you are crediting the loan, you are still increasing the loan. So you are giving them only 62,000, and that will be increasing the equity. But the remaining of the 12,500 will be for us. Okay, that is a share premium to us. That is a gain, but we are going to be keeping it as a share premium. Okay, this particular 12,500 will now be used to what? Pay what? The loan. If we are using it to pay the loan, it means that we are going to be taking the money from our bank or cash account to pay. Okay, so that reserve will still be there. We cannot write it off. If you are writing it off, it means that you are going to be debiting. Which account are you going to be crediting? The loan again. Loan is a liability. So if you are crediting, it will still be an increase. Okay. Sina, are you okay? Or
Yes, I'm okay. I'll take that.
So if you want to, if you like, we are giving you only 62,500. But what happens to the 12,500? It is the money that we are dashing the company. So the company will keep it as share premium. Whenever shares are being issued at a value more than the share price, that is a gain to the entity. The entity will keep it as share premium. Okay. And that share premium is in our bank account. We have that cash in our bank account. Now we are saying that we want to use our 12,500 to pay our loan. It means that the cash is going to be reducing by 12,500, but not the gain that we are having. The gain will always be there for us. It's a gain. But just that when you are paying, the money is in the bank account. So you use your bank to pay. So the bank will reduce and the loan will also reduce. So you debit the loan and credit the cash or the cash equivalents. All right.
Thank you, sir.
All right. 6.
It's 20% of the carrying value of preference shares and debentures are to be written off if the capital reconstruction scheme is to be implemented. The debenture holders are also willing to convert 100 million Ghana cedis of their value to ordinary shares of 1 cedi 25%.
Okay. So what are they saying? The reorganization will be implemented. That is why we are doing this. So forget about that. Okay. What is the value of the preference shares? What is the value of the preference shares? That is 9 million, isn't it? So if they are writing 20% of, how much will be the amount that they are writing off? Their value is 9,000. So writing 20% of how much will be that?
That was 1,008. 1,008.
So we come and reduce this by 1,008. That will be a gain, isn't it?
Yeah.
Okay, so we have the preference shares. Preference shares to be 1,800. The debentures will also be written off by 20%. So what is the value of the debentures? 0.2 multiplied by 150,000. They are writing off 30,000. So that will also be, these are owings. So if these people, if they are forgiving us, that is like a debt forgiveness. So they are forgiving, or they are, so preference shares, debentures will be 30,000. Is that correct? All right. So what are they saying again about the debentures? So the value that we are going to be owing them will be 120, but they are saying that the preference and the debenture holders are willing to convert all, oh no, that is not the part. Okay, the debenture holders are willing to convert 100 million of their fair value to what? Ordinary shares of 120. So currently, how much is the amount on the debentures account? What would be the amount on the debentures account?
120,000.
Okay, this 120,000, they are saying that they are taking how much?
100.
They want to be part of the equity shares. So what will be the remaining amount on the debentures now?
20,000.
Okay, so we come and remove the amount that will be converting to equity shares here. So you count your equity shares, you now add the 100,000 to that. So the debentures of debentures to the value of 100,000 are no longer debentures. They are now owners of the company. So the debentures holders will now be having only 20,000 Ghana cedis. That is it. Okay, let's see what we can. 7.
Senior,
Yes, please. I'm with you.
Senior.
Yeah, I'm with you.
Yes, they're not the go back to the listing. The 300,000 indicated.
The 30,000 is 30,000. Is it a debentures? Sina, can you hear me?
Yes, senior.
Is it my network or his own?
Deducted. Where did we get it from?
The 30,000? Sina, is it the 30,000? Yeah. He's gone. Let's be moving. You will come. Auntie Agnes.
$50 million Ghana cedis of the 140 million Ghana cedis trade payables are preferential.
We have done that already. That is for
Okay.
liquidation, yeah.
Okay. If the reconstruction scheme is to be implemented, trade payables and 15% long-term loans are willing to write off 90 million Ghana cedis and 50 million Ghana cedis of their values respectively.
Okay. So this is this will be a reduction in liability, isn't it? So this will actually be a gain. But let's come here. The trade payables are writing off what? 90 million, isn't it? So let's go to how much they are having currently. The trade payables, they are having 140. So we are going to write off this by what? 90. So that will come over here as a gain to the company. That will come here as a gain to the company. So let's come here and have the trade payables. That will be 90,000. Okay. The next people is what? 15% long-term loan. So they are also writing their value down by, so long-term. Okay, that will be bank loan. I'm sure that is bank loan. So bank loan will also be an income of 50,000. So let's go to the bank loan now, and we take our 50,000 from this. I hope we are okay with the treatment. Are we okay with that?
Yes, please.
Okay. Okay. Auntie Agnes, let's be moving. Auntie Agnes, let's move in.
Okay. The debenture is secured by a floating charge over the assets of Kabua Limited. Other than the investment, the current market value of the investment is 15 million Ghana cedis.
Okay, let's go there. What is the value of the investment? They are talking about the investment property there. What is the current value of the investment property? The book value is what?
Oh,
Okay, but they are saying that
okay.
the current value is 15. So what is happening?
It has increased.
So we come and increase our this by 3,000. Okay, then we now have the investments again on the investments by 3,000. That will be 15,000 minus 3,000.
Minus 12,000.
Minus 12,000 rather. Okay, so minus 12,000. That will give us 3,000. Do you have any other thing that's supposed to be here? I'm not sure. So we have the liquidation values. The liquidation expense is for only if we want to liquidate. If you are reconstructing, the expense should be a reconstruction expense, but we are here to. There's no reconstruction expense. The liquidation values for the asset as well as expenses to be incurred are considered relevant in the event of any capital reconstruction scheme. Okay, so there's no expense relating to this. Can we now put our capital reduction account together and look for any difference there? So we are going to be having 5,000 plus 48,000 plus 7,000 plus 20,000 plus 92050. Debit side, I'm having 172. The capital surplus, we'll deal with it if there is any loss from the reorganization. So if there is any loss from the reorganization, we write it against the capital surplus. Okay. So we have 15,000 plus 38,250 plus 1,800 plus 30,000. Okay. Plus 30 plus 90 plus 50 plus 3,000. I'm having 228050. Is that correct?
Yes, it's correct.
Yes, it's correct.
What is the difference? Where are we getting the difference? There is a difference of 56,000 on the what?
56,000 on the debit side.
Okay. So if the income is more than the what? The expense, what is happening? That will be an income, isn't it? Okay. So the income is higher than this. This will be taken to capital surplus. Okay. The gain will be taken to capital surplus. So we have 56,000. So we have 228050. 228050. Okay. So our capital surplus will now be increasing by additional 56,000. Okay, can we put our figures now together? So this will be, yes, please.
I thought you were saying the 70,000 capital surplus would have written off against the retained earnings in the capital reduction account.
If there is a loss.
Okay.
Okay. So if you write the 5,000 over here, you will see that if you bring the 5,000 over here, you will see that this will now be, the gain over here will be more than the 56,000. So if you go and add it to the capital surplus, it will still be like the same value that you're having. We only write off the capital surplus when there is a loss from the reconstruction. So if there should be a loss, if this 56,000 should be a loss, the loss will now bring the capital surplus over here to cancel the loss.
So then it means that the loss should be at the credit side.
Yes, the loss will be at the credit side. So we bring the capital surplus there to cancel it.
Okay. So, but I thought when you're doing capital reduction, related to the retained earnings and the capital surplus, you have to write it off.
Unless there is going to be a loss. If you write the capital surplus off, you will still be having, if you write the capital surplus, you'll be bringing the 70,000 here, isn't it? Okay. You bring 70,000 to, you bring a 70,000 to what? To credit side, because the capital surplus is a gain. Okay. Okay, so if you write it, the 70,000 will come here. If you do everything over here, your difference, which will be going to capital surplus, will still be 70 plus the 56,000.
And it will be the same figure. Okay,
It will be
thank
the
you.
same figure. All right. But if there's a loss on the capital surplus, that one you have to write it off. But if there's a gain, you just wait for the reorganization or the reconstruction to take place. If there's any loss on it, then you now write the loss against the capital surplus. Because if you write the capital surplus, at the end of the day, if you have a gain, the gain will still be treated as capital surplus. Okay, so you just wait for the reconstruction. If there's any loss, then you now write the loss against the what? The capital surplus. Senior, I hope you're okay now.
Thank you.
All right. So let's put the figures. You can put the figures together now in the, so that is it. It's not a big deal. So this will be dash. This will be 9,000. This will be dash. This will be 9,000. This will be 50,000. This will be 20,000. And this will be 70,000 minus 50. 70,000 minus 62,500. That will give us 7,500. We have 12,500 here. This will give us dash. Capital surplus will now be 126,000. 70 plus 56. 126,000. Our preference shares will be 0.8 multiplied by 9,000. 7,200. So you can just put the rest up. So your assets, 15,000, 60,000. So 15,000, 60,000. Investment property will be 15,000. Goodwill will be written off. So this will be dash. We put a dash here. Your inventory reduced by, so this will be 88,000. And the receivables has also been written off, isn't it? Receivables has been written off by 92. So the receivables will be 92,050. So that should be giving us the value over there. So 194,000 plus 50,050 minus 92,050. Okay, that should give us 160,000. Okay, so you can put the 160 plus 88,000 to 48,000. So okay, this is supposed not to come here. Cash and cash equivalent is here. So our cash and cash equivalents, that will be 65,000 plus 75,000 minus 12,500. That will give us 127,500 plus 88,000 plus 160,000 plus 15,000 plus 60,000 plus 15,000 466 4655 500 51,000 minus 38,250 51,000 minus 38,250 plus 62,500 plus 58,050 plus 100,000. That will give us 300. $7,200 plus 126,000 plus 12,500 plus 27,500 plus 50,000 plus 9,000 465,500. Let's look at the question number 2. Although I've solved this question so many times, but how we would run. Auntie Agnes, are you there?
Yes, please.
Oh, should I solve the business valuation or I should solve this one? I've solved this one so many times.
The business valuation.
Okay. So this one, I've solved this one so many times. So you should have the figures in your on your listing. Please, it is a, if you read a question from the top to the down, it's a likely examinable question. So you can Auntie Emilia, I hope you are now familiar with the figures for the two.
Yes, I've seen it. I'm okay with it.
Okay.
I've
So
now seen the original one.
you have seen the original question?
Yes.
Okay, okay. Please, you can see this question on 1st July 20.
Please, can you have a test for us?
Can I
Can
have
you
the,
look for a professor and give us questions?
oh, I mean, that one, I can just come to you and say this will happen, but it will not happen. I don't want to be a false prophet. Let me be in my okay. So yeah, so this question, I've solved this question, sir. Okay. Okay. Sina Deborah will tell you I've solved this question, sir. So please let's go over with the solution again. If you are new over here, you can check our last sitting revision, or I can still share that particular link and I will tell you where the distance is. Please, it's an examinable question. If you look at it, you also you know that okay, this question is likely to be examinable question. So you have to, we solve it in normal class, you have to go through again. It's the same thing that I'm coming to say over here. So let's just talk about the business valuation, because last sitting I didn't solve a question on business valuation and Deborah and Co, they want to say that I did this thing to them. So
Should I take question 7?
it's supposed to be question number 3. So I want to edit the question number.
All right.
Please, where the question number 1, you see, November, they brought a question from this is University of Education Winneba. They gave them an assignment and they brought a question like that. So it is from that particular assignment that I took the question 1 also. So you should also go over it again together with the question number 2. It's also important. Let's take the question number 3. Auntie Agnes, can you see my screen? Question number 3. Auntie Agnes, are we together?
Question 3. Please, should I go ahead?
Yes, ma'am.
The board of directors of Predator Limited, a Ghanaian company, the board of directors of Predator Limited, a Ghanaian company, is considering making an offer to purchase Target Limited, a private limited company in the same industry. If Target Limited is purchased, it is proposed to continue operating the company as a going concern in the same line of business. Summarized details from the most recent financial statements, statements of financial position and statements of profit or loss of Predator and Target are shown below.
Auntie Agnes, are you ready?
Yes, I've read up to the financial statement, but I've not taken the financial statement.
Okay. So I guess you are busy. Okay. So you just ignore that. Then let's come to the
Unless you scroll up.
okay.
Target Limited, 25 pesos ordinary shares. A. Target shares are owned by a managing director who receives an annual salary of 120,000 Ghana cedis. Dominates the company. This is 40,000 Ghana cedis more than the average salary received by managing directors of similar companies. The managing director would be replaced if Predator purchases Target.
What is up? What are they talking about? There will be a cost savings there, isn't it?
Yes.
Of how much?
$40,000.
Okay. Okay. Let's come to the B.
Okay, B. The freehold property has not been revalued for several years, and it is believed to have a market value of 800,000 Ghana cedis.
Okay. The C.
C. The value of plants and equipment in the statement of financial position is thought to reflect its replacement cost fairly, but its value, if sold, is not likely to exceed 800,000 Ghana cedis. Approximately 55,000 Ghana cedis of inventory is obsolete and could only be sold as scrap for 5,000 Ghana cedis. D. Ordinary shares of Predator are currently trading at 430 pesos ex-div. As a suitable cost of equity for Target has been estimated at 15%. E, both companies are subject to corporate tax of at 25%. Required. Estimate the value of Target Limited using different methods of valuation. Using the different methods of valuation and advise the board of Predator how much it should offer for Target shares.
Okay, so this one they are not giving you the methods that you have to use. Okay, you have to pick the methods that are comfortable and that you think is applicable, or that you think that based on the information over here you can use. Okay, what will be the first one? At least you should use 3 methods. Okay, what will be the first one that you'll be using?
The net asset
The net
method.
asset.
Okay, net asset should always be the first one. Okay, the second one will be what?
Can use the dividend valuation.
Okay, we can also use the dividends. Okay, another one is what?
Earnings.
Okay, we can use the price earnings, or we can also use the earnings yield, or any of them. But I'll be using all the possible ones that we can use over here. Okay, so the first one should be the net assets. Okay, let's pick the okay, so let's pick the right. So let's pick the question number 3. So let's use the first method. That will be the net assets. So the net asset, what we do is that we have our total assets. Okay, we have our total assets. Then we now adjust with the total assets should always be at the market value. So we are doing for target company, isn't it? What is their freehold property? What is the value of their freehold property?
460.
Okay. So fair value of their freehold property should be 460. That might be increasing or reducing. So we put it in brackets like 460 here. Let's count to the currency. Then we count to the next item. Plant and equipment is what?
1,310.
Okay. So plant and equipment. Plant and equipment is 1,010. Okay. Let's
Please,
count.
in the exam situation, can you write PPE?
Yeah, no problem. PP is accepted. Okay, but if you're writing the PPE, you can see that they have separated the freehold. So if you're writing the PPE, that will be, but you can combine the two. Then you now have 460 and 310. You put it, you write PPE and now combine the two, because you can see that the property is now separated from the plant and equipment. Okay, so let's count to inventories. How much are we having for
330.
330. Okay, the next one is what?
Receivables 290.
Receivables will be 290. 290.
Cash 20.
Cash is 20. Okay, let's go now to let's go to the footnote. There will be some fair value adjustment. This one we are selling, so the assets should always be valued at their fair value or their current market value. So we are going to be having the liabilities. Let's have the liabilities there before we go. So we have liabilities. Okay, liabilities is what? Yeah, you can pick the net assets and now do the increase and then the decrease. Okay, that will not be a problem over there. So our current liabilities is what?
518.
518. Okay. Do you have any non-current liability there? Medium-term bank borrowings. Okay. Medium-term bank borrowings. So we can say borrowings. How much is it?
768.
768.
Okay, 768. Okay. Okay. Let's come to A. Target shares are owned by a small number of private individuals. Each managing director who receive an annual salary of 120,000 dominate the company. This is 4,000 more than the average salary received by managing directors of similar companies. Okay, the managing director will be replaced if predator purchases targets. What do you think they are trying to talk about over here? There will be a cost.
Okay.
There will be a cost savings of
Yeah.
what?
40,000.
40,000. So this 40,000, how do we call it? This 40,000 will be used for a particular method.
It
Uh,
will be to adjust our profit.
this will be a cash flow, cost savings. We are going to be having a cash inflow. We are going to be saving 40,000. So that would be a cost savings, which is a cash inflow to us. Okay. If we are hiring the same person, we are going to be paying 120. Okay. But since we are going to be removing this person, we are going to be saving a cost of what? Of 40,000. So that might be a cost savings that we are going to be getting from that. So you can also use that as cash flow for cash flow valuation. Okay, let's come to the B. The freehold property has not been revalued for several years and is believed to have a market value of 800,000. So what is the value of the freehold property? What is the book value?
460.
Okay. So are they going to be selling at 460 or they will now sell at the market value?
At the market value.
Okay. So this will increase by how much?
340.
Okay. So you add a 340 here to have your 800. Okay. Let's go to the next one. Okay. The value of plant and equipment. The value of plant and equipment in the statement of financial position is thought to reflect its replacement cost fairly, but its value, if sold, is not likely to exceed what? 800. Okay. What are we going to be using? The fair value now will be what? Will be 800,000, but the replacement cost is what? Is 1310. What value are you going to be using?
We'll use the 800,000.
Are you sure?
No, use the fair value.
The replacement cost is the 1310. Okay. And
800.
the 800,000, they are saying that if it is being sold, now, the value is likely not to exceed what? 800,000. So you can sell less than 800,000, or you can sell than that particular, or maybe at that particular value. Come here. Okay. If Target Limited is purchased, it is proposed to continue operating the company as what?
The going concern.
In the same line of what?
Business.
Okay. If the company will be purchased and it will be operated as a going concern, mostly we use the replacement cost. So if you want to replace the asset right now, what is the what? What is the value? Or just take it like business valuation, just pick the highest value. Okay. Any value that will be available. They can give you value in use, they can give you fair value. pick the one that is the highest one. Okay, let me just put it like that. Pick the value that is the highest one. Just pick the highest value. So if you want to replace, it is now 1310. Okay, so the replacement cost, just like that, is the current what value of the assets in the market. So since you are going to be using the assets, it's either you allow us to sell it so that you come and buy that particular one from a different person at the 1310, or you accept the 1310. You want to continue using the what? The entity. You are going to be continuing as going concern. You are going to be operating like the way we are operating. Okay. It's either you pay the 1310 to us, or we sell this particular asset to somebody and you go and purchase it back. Because if it's a machine that we are using, if we sell the machine, it means that you have to go and buy that machine to continue. So you have to going to be paying the 1310. So if it is for going concern, we always use the replacement cost unless the replacement cost is not available. Or just pick the highest value between the two. Pick the highest value between the two. Just pick the highest value, the market value, and then the replacement cost. Just pick the highest value. But if it is between costs, if it is between the book value and the fair value, you are not going to be selling at the book value. You will be selling at the market value. But if you are giving value in use, or you are giving replacement cost and fair value or market value, just pick the one that is the highest one. Okay, so this asset will be shown at the replacement cost, because if you don't want to pay the 13,810, I have a car. I'm using the car for Uber business. You want to continue. If you want to buy a new car now, maybe the new car will be 20,000. So you want to continue with the business that I'm doing. You want to be using the machine. Okay, I will tell you, either you pay an amount closer to what? To the replacement cost, or you go and buy the new car. That is it. Okay, so since it's for a going concern, we use the replacement cost. So that will be still be at the 1310. All right. Let's come to what are we going to be having there? Approximately 55,000 of the inventory is obsolete and could only be sold as a scrap for what? 5,000. So what will be the inventory reduced by how much?
50,000.
Okay, inventory will be reduced by 50,000. So let's have 1310, and this will be 280. Is that correct? Receivables will be 290. Our cash will be 20. If you add, what are you having? I'm having 2,700.
Confirm.
Okay. Okay, so we have 518 here, 768 here. What will be our total?
1,286.
Okay, so we have 1,286. So our value will now be 1441.
14.
Okay, so that is based on the net assets. We should be using this one. So you can also use price earning ratio. Okay, you can also use a price earning ratio. The price earning ratio, you can use either average. We have so many options. You can use the price earning ratio, which you'll be using the average, or you use the current value. So the price earning ratio. Okay, what is the current year profit? We have to take the current year profit. Okay, they say T5 is 5 years ago, and T1 is the most recent year. PAT is profit after tax. So for target company, what is their recent earnings? What is their recent profit after tax?
183.
Okay, that particular 183, something's supposed to affect the 183. The obsolete inventory over here, the reduction in the inventory, is it profit or loss item? Reduction in inventory, is it profit or loss item?
So profit and loss.
Okay. So we know that the market price or the value under price earning ratio, the value under the price earning ratio is calculated as a price earning ratio of a similar company multiplied by the profit after tax. And the profit after tax should always be the adjusted profit after tax. So there will be some items that will be affecting that. So what we do is that, are we giving price earning ratio? Are we giving price earning ratio? But we can calculate the price earning ratio of a similar company that is listed. Pre-data will be listed. Okay, pre-data will be listed. Okay, so what is the recent earnings per share of the, what is the recent profit after tax for pre-data?
20.04.
Okay, 20.04. Their figures are in million, isn't it? Okay.
Yes.
So we can find the price earning ratio of the pre-data company, which will be listed because they are having market value. It means that they will be listed. So what will happen is that this will be calculated as market price over their earnings per share. Okay, let's calculate the earnings per share for them. That will also be too long. What I will do is that, can we find the number of shares for, what will be the number of shares for pre-data? Pre-data, their shares are trading at 50 pesos. So what will be the number of shares for them? And their value of the shares is 35 million. So divided by 0.5.
70.
I'm having 70 million. Okay. So their number of shares, let's calculate earnings per share for them. So their earnings per share will be the recent profit, which is 20.04 million divided by 70 million. What will be the earnings per share?
$0.29.
0.29. Okay. We have 0.29. Okay. So our price earning ratio will now be calculated as assembling. Our price earning ratio will now be calculated as, let's go and look for the market price for them. What is the market price? They have given us their market price. What is their market price? D. D is what? The D.
430%.
Okay. If we are changing to
430.
Ghana cedi, that will be how much?
0.43. Oh, okay.
Okay.
0.3.
The earnings per share is calculated in cedis. So we have to change this one also to cedis. So that will be 0.29. So 4.3 divided by 0.29. What are we having?
So it's supposed to be 0.430. It's 430 pesos, not 430.
No, so if you divide by 100 pesos, we divide by 100 to get cedis. Is that correct?
It's correct, sir.
Yeah, 100 pesos is 1 cedi.
It's 430 divided by 100. It's correct. 4.3.
So that will be 4.3 divided by 0.29. What are we having? 14.2. So this will give us 14.2. That will be their price earning ratio. So we have 14.82 here multiplied by, then we come here 20. Their recent profit for the target company. What is their recent profit here? The recent profit will be 183 minus the
183.
obsolete inventory there. So that will be 183 million, 183,000 minus 50, which is the inventory loss.
55.
So the inventory loss is we are selling it 55, we are selling it for 5,000. So the loss will be 50.
So once we adjust the PE ratio.
After the answer before I adjust that. Okay.
Oh, okay.
So approximately 55,000 of the inventory is obsolete and could only be sold as a scrap for 5,000. So we are going to be losing 50,000. So that will be termed as the inventory loss, which will be added to cost of sales, but that has not been taken into consideration before getting this. So 14.82 multiplied by 133. What are we having? I'm having 197.
197.
Okay.
And 06.
Okay. Then we multiply this by, let's say 80%. Okay. So what are we having? I'm having 15, 7, 6, 8, 4, 8. The figures are in 3 zeros. So this will also be, we add 3 zeros here. Okay, that will be 1,414,000. Okay, so this will also be 1,576,848. So we can use the price earning ratio. That is 1. We can also use average earnings. We can use average earnings also. That will also be another method. So we can also use average earnings. So we can also use average earnings. The average earnings, what we do is that we add all the earnings and divide it by the number of years that we have there. Okay. So what will be the earnings? We can have 143 plus 162 plus 151 plus 175 plus 183 minus 50, all divided by 5. I'm having 152.8. The last year, the current year will be 133 because we are adjusting the inventory loss against it. If you divide by 5, so let's pick all those, the average earnings. So our average earnings will be calculated as, what are we going to be having there? That will be 143 plus 162 plus 151 plus 175.
Hello, sir.
Yes, please.
Please, I wanted to find out, can you use only the current figure to do the earnings per share, or you need to do
No.
everything?
The average is also a method. It's also a different method. So you either use the current one as one method, or you can use the average earnings also to tell them the amount that they can pay. It's also a different method that you are using. So this one will be divided by 5. So we have our average earnings to be.
And follow-up question, pertaining to the average, we are just using a simple average. Can you choose to use the weighted one?
Is that?
Hello, sir.
I said pertaining to the
please, I wanted to know why we
using,
subtracted the 50 from the average.
No, let me take the first person. Let me take the first person. Yeah.
Yeah, hello.
Yes,
Please, pertaining to this, we are using a simple average. And I was like, can you use a weighted average pertaining to this one?
No, we always use a simple average. Okay, so Sine, I can take your own now. All right. Senior, I can take your own now. You are. Why did we subtract? So our market price will now be 14.82 multiplied by 152.8. Then you can just address it. You can just adjust it by the 80% straightforward. So 14.82 multiplied by 0.8 multiplied by 1,000. I'm having 18115, 18115, 1811596.8. So you can also use the average earnings to calculate the method for that. You can also use the dividends methods, or you can also use any yield. You can use the earnings yield. If you want to use the earnings yield, you have to find the earnings yield for the what? You have to find the earnings yield to the predator company. You have to find the earnings yield for the predator company. Okay, because this company they are not having market value, so they cannot have earnings yield. So you have to find the earnings yield for those people. How do we find the earnings yield? So we can find our earnings yield for the current year straightforward as the earnings per share over the market price, okay, multiplied by the 100. That will give you earnings yield. Okay. Okay, you have a point there. You see that after, okay, both companies are subject to a corporate tax at 25%. Okay, so after adjusting for that, you see they have already charged this profit is profit after tax. Okay, they have already charged tax of that party. They have charged a tax on a profit. So this one is already profit after tax. So 183. This is the profit after tax. But the only thing that you can take into consideration will be the tax effects on that particular one. So you'll be having your 183. Okay, you'll be having 183 minus the 50. That will give you 133. Okay, so the only thing that we can think about is deferred tax. The only thing that we can think about over here is deferred tax, because the tax authority will not be writing the inventory down in their books. The inventory will still be at cost for them. So you only be entitled to the tax when the inventory has been sold. So you have to now be creating for what we call deferred tax assets. Okay, so that will not actually affect it. But if the profit given to you is just profit before tax, then we can now charge our normal tax. Okay, but this one we are going to be looking at the issues of deferred tax, because if the inventories are sold, they will be giving us a capital or a tax allowance on the 50. So we can now estimate a deferred tax asset on that, and that deferred tax asset will be added to our net assets and also be taken away from the profit over here, because that will be a deferred tax. But that is not an issue that you have to pay attention to. If you are doing this, what we do is that if you are giving profit after tax already, just take the adjustment from this one and move on. Okay, forget about the issue of the deferred tax. Just take that one because you are giving profit after tax already. So just ignore, just subtract the figures and now move on with that. You don't have to really think about the issue of tax on that, because we need to have a lot of issues to calculate the tax. So since they have estimated the tax already, just take that is the tax for the year, and you subtract it from your you subtract the adjustment from your profit after tax and just use that figure. That is all. Okay, so attention is not given to, unless the question is telling you that this is going to be creating tax issues, then for that one you have to pay attention to that. So I hope you are okay with that particular one. All right. All right. So let's use the earnings yield. Okay. So our earnings per share calculated was what? Okay. Our earnings per share calculated was 0.29 for those people. So 0.29 over 4.3 multiplied by 100. What is the earnings yield for the pre-data company? I'm having 6.74.
Confirm.
Okay. So
Yeah.
you can use the earnings yield also. Okay. If you come to the earnings yield, you can just use a simple earnings yield. How do you calculate the earnings? How do you calculate market price under the earnings yield? The market price under the earnings yield will be calculated as the market value will be calculated as the profit after tax of them divided by the earnings yield. We are finding the total value, not value per share. So we can come here and have market value is equal to profit after tax for them was 183 minus 50. So that will be 133 divided by the earnings yield of, we have to increase this by maybe 20%. So 1.2 multiplied by 0.0674. Okay. Yeah, we are using current profits. Okay. The current profit will be 183, but the current profit is not actually 183. There was a inventory loss. So the inventory loss must be net against the inventory loss was netted against the current one. So the current profits have to be 133. Okay. So let me multiply this by 1.2. So I'll be getting 133 divided by 0.081. What are we having?
165. Hello.
Yes, please. So
165.43.
okay, we are keeping 3 zeros, so just change it to 1641 1641 975.3. Okay. We can also use dividend valuation. So we can also use the dividend valuation for them. Okay. We can also use the dividend valuation for these people. Okay, the dividend valuation, we can use the dividend yield. Okay, the dividend yield, which will be dividend per share over the market price, which will be the market price is equal to dividend per share over the dividend yield. What we have to do is that we have to find a dividend yield for the pre-data company also. Yeah.
Is it the average earnings that has ended on the 1641975.3?
No, the average earnings ended here.
181159.
Yeah. So this is, let me make this one 3. Let me make this one 4. Let me make this one 5.
Oh, okay.
Okay. So we can also use the dividend valuation. The dividend valuation, we can use dividend yield. So we have to find the dividend yield of the pre-data company. Okay. That will be dividend per share divided by their market price multiplied by 100. Can we find the dividend per share of the pre-data company? Their recent dividend per share, that will give us what? Their dividend is 12.62. Okay, so we can use the dividend per share. Their dividend per share will be equal to 12.62 divided by the number of shares, which is 70 million. So what will be the dividend per share? 1262 divided by 70. Getting
0.18.
okay, 0.18. So we can now use that to find the dividend yield for them. So that will be 0.18 divided by the market price of 0.30 multiplied by 100. So we'll be having a dividend yield of 4.30. I'm getting 4.2. 4.2. Okay. So you now have to come to the target company. Okay, you have to come to the target company now to value the target limited. So for you to value the target limited, you have to know the dividend yield, the earnings yield of a company that is operating in what? In similar industry, because they are not going to be having those values. So we use the dividend yield, the earnings yield, the price earning ratio of a different company. So these are not given to us. You have to calculate it yourself before you can move on to. So we can have our market price over here to be equal to the dividend per share of the target company divided by the dividend yield calculated there. So their market price per share is equal to dividend. We can take their total dividend. What is their total dividend for this year? 113.1. Okay, so we have 11300 divided by 1.2. We have to increase this by 20%, multiplied by 0.042. Okay, what are we having? 11300 divided by 1.2 multiplied by 4.2 divided by 100. I'm having 0.0504. Is that correct? And this is our. Okay. So we are going to be having our 224404.7.6. Okay. You can also use dividend growth. Okay. You can also use dividend growth. Okay. The dividend growth, you can see that you have been given cost of equity of the target company. You have been given cost of equity of the target company. So the ordinary shares of Predator are currently trading at 430 pesos SD. A suitable cost of equity for target has been estimated at what? 15%. So we can find our market value using the dividend growth, which will give us our KE is equal to DO into bracket 1 plus G divided by PO. The PO is a market value, all plus the G. So if you are looking for a PO now, that will be giving us DO into bracket 1 plus G divided by KE minus G. Okay, so the G is the dividend group, which you can calculate over here. Very simple. So we have so many dividends over here, and you can calculate dividend growth here. Okay. Yeah, Deborah, how do we calculate dividend growth? Deborah, dividend growth. Agnes, dividend growth.
Hello.
Yes, please.
The formula, do you need the formula?
Yes, please. I want to take it from the FM student.
Oh, okay, sure.
Those people who just passed the FM. Auntie Agnes, how do we calculate dividend growth?
Current minus previous, all over previous.
No, this one, we have so many dividends. We have more than a year. So we just calculate it.
So is the recent one divided by the first one. into root number 5 minus 1.
So you want to look at the formula somewhere.
Oh, no.
So the growth, which is the gene, is calculated as the current dividend, which will always label as the D1 over the initial dividend of this, all exponent 1 over n, then minus 1. Okay. Then the answer, you can multiply the answer by 100. Okay, the D1 is the current dividend. The D1 is the current dividend. So the current dividend now is the T1, which is 113.1. Okay, so we have our gene to be 113.1 divided by the initial dividend was the starting dividend, which is T5. That will be 85. So that is the D0, 85. Okay, 0.0. So the issue now is the N is the number of growth experienced over the what? Over the period. So we have this from T5 to T4. That is one growth. The growth is only one. Okay. From T4 to T3, that is another growth. So 2. From T3 to T2, that is another growth. And from T2 to T1, that is another growth. So there was what? 4 growths over the 5 years. So you just find the growth. Here to here is 1. Here to here is 1. Here to here is 1. And here to here is 1. So that is a growth that we calculated. The growth is between 2 years. So that will be 4. So we have exponent 1 over 4. Okay. So this answer minus 1. So someone should do it on the calculator and give us the answer. Someone should calculate and give us the answer.
Okay, I got 0.074.
0.0.
0.074.
Okay. Okay. So we can now calculate this one now, our market price, which will be calculated on total level, will be our current dividend of 11.1 into bracket 1 plus 0.07. So we are just quoting this. So we can, since we are calculating this on total level, use the total dividend, okay, to find the total market value. So we have our KE is the cost of equity, which is given to us as 15%. So we have 0.15 minus 0.07. So the top, what are we having? Okay, I'm having 121.017 divided by 0.08. I'm having a total of 151.2712.5. Okay, so if you are using dividend growth, this is the value that you are going to be getting. So you can use any method at all, any method that you are comfortable with. Okay, so they are asking you to advise them the amount that they should be paying. So the amount that they should be paying, you just quote from the least to the highest. So they should pay within that particular range. Any amount within that particular range should be what should be paid for. So if you're using a net asset, it is 1,414,000. If you're using the price earning ratio, it is, if you're using the price earning ratio, it is 1,576,848. So if you come to the remaining one, this is also higher, and this is also higher. This is also going to be, okay, this is also higher, and this is also higher. So what do you have to tell them? That they have to pay any amounts within the range of 1,414,000 to the highest amount here. So the highest amount over here is 2244047. So that is how 222,44047.6. So they should pay any amount within this particular range. That's what you're going to be telling them. So you calculate the price and tell them that they should pay any amount from or within the range of the lowest value and the highest value. So this is just about this particular question. There's nothing difficult. The only thing that is making it difficult is to calculate your price earning ratio before you value, and also calculate your dividend yield and earnings yield before you value. That is the only issue about it. Please, any question? Yeah, any question? There are any issue?
No, senior, I'm okay. Thank you.
Okay. Please, so if there are no issues, we will meet tomorrow to finish with the standards. All right. Good night.
Yes.
Yes, please.
Sir, tomorrow what time?
The same time.
That's good. Thank you.
Oh, okay. So tomorrow is the standard thing.
Yes, please.
Okay. Okay.